Hello and welcome to the fourth episode of RavenPack's Chat with the Expert series. My name is Joaquin Montfort and I am the content executive here at RavenPack. For those of you who may not already know, RavenPack is a pioneer and leader in the field of alternative data and big data analytics, helping investment management firms derive value from unstructured data sources. The topic we will be discussing today is what can new sentiment data tell us about the impact of the coronavirus shock on specific sectors and financial markets in general? The session is co-hosted with our partner Wolfe Research. Our presenters and experts today are Yin Luo, US Quantitative and Research Economics and Portfolio Strategy at Wolfe Research, and Peter Hafez, Chief Data Scientist at RavenPack. At the end of the webinar, we will be hosting a Q&A session during which attendees will be able to ask questions of the presenters. So now to kick things off, here's Peter Hafez.
Thank you, Joe. While the most recent period has proven itself to be very challenging, both from a global health and economy perspective, it has also been interesting times to be a quant researcher trying to glean valuable insights on the COVID-19 pandemic from unstructured data. Throughout these difficult times, we have received a lot of feedback from our clients who have seen great value from the RavenPack dataset, not only from an alpha perspective, but also in risk management as the crisis has unfolded. Internally at RavenPack, the data science team has also been tracking the coronavirus as it appeared in the news and as it started impacting the global economy. We did this using the RavenPack entity detection capabilities combined with event detection and our keyword search functionality, all of which was leveraging our natural language processing engine. It was quite clear that even before the dramatic uptick in confirmed cases of the coronavirus, that the number of news articles covering epidemics and pandemics as a topic had significantly increased. From the graphic, we can observe how both the news about the virus as well as confirmed cases spread across the globe, starting from January 2020, with news generally being a leading indicator acting as an early warning sign for the widespread pandemic. In fact, RavenPack was able to pick up the first event linked to Wuhan already on December 31st from local Chinese media, and rumors about a SARS-linked virus on January 1st from Taipei Times. While China news was driving the conversation in January with a peak volume early February, US and Europe volume had already started to pick up. By end of February, news outside China was dominating the conversation. Comparing the media coverage of the coronavirus to other epidemics over the last 20 years, including SARS, swine flu, and MERS, it also became clear early on that this was serious. Specifically, the volume of news covering pandemic and epidemic events went past 2 standard deviation above normal volume already on January 26th. 5 days later, we surpassed 4 standard deviations and moved into an abnormality spike surpassing other epidemics. On February 15th, volume reached its peak, reaching 8 standard deviations above normal and twice as high as seen during the MERS outbreak. At the time, of course, the billion-dollar question was, to what extent could we expect this to hit financial markets? Tracking the volume of news talking about recessions might have given us an indication. Interestingly, the first time we saw the coronavirus mentioned with recession was on January 16th, well before the equity market starting to get hit. About 1 week later, 10% of all recession news would mention the coronavirus. On February 17th, the number had reached 50% of all recession news, only a couple of days before the S&P 500 started to drop. Finally, on March 12th, we reached the 90% threshold, making it clear that coronavirus was driving close to all recession mentions, with total volumes moving beyond the September-October spike in 2019 and at levels not seen since the financial crisis. As shown, looking at news, analytics, and sentiment coming from unstructured data can be valuable during the buildup of a crisis, acting as an early warning sign and as an input to a nowcasting framework. In addition, being able to search and query the underlying content can be valuable for coming up with actionable insights that can feed new investment ideas. As coronavirus outbreak unfolded, clearly some sectors were higher risk of getting impacted. Clearly, sectors relying on travel and tourism should get negatively impacted as the panic was spreading globally. Biotech could get positively impacted due to the arms race of coming up with a vaccine. Internally at RavenPack, we've been looking into how to identify winners and losers within various industries. In particular, we were interested in understanding the correlation between an airline's China exposure and its stock price as the coronavirus unfolded. Not surprisingly, we found that US and European airlines that had appeared more in the news with China over the last 2 years generally underperformed airlines with little news exposure, at least during the first week of the coronavirus outbreak as it hit global equity markets. However, as the virus spread, impacting other regions beyond China, airlines with lesser exposure, here represented in red, also got hit, but with a 1-month delay. Turning to biotech, we wanted to identify companies more closely linked to coronavirus in the news, especially as it related to clinical trials and product releases. Again, not surprisingly, we found that firms with greater exposure to coronavirus significantly outperformed the biotech peers. In fact, a strategy that bought the top 5 companies linked to the coronavirus on a daily step forward basis would have outperformed the S&P 500 by more than 50% during the period. Lastly, we have also been looking into performance of sentiment across a stock portfolio, focusing particularly on the most recent major crisis periods, including the financial crisis, the Greek debt crisis, and the current corona crisis. Our sentiment measure is extracted from news covering events around earnings guidance, analyst ratings, layoffs, facility closures, and a wide range of other corporate news events. In general, positive sentiment outperforms negative sentiment stocks, both during normal circumstances and during crisis periods. However, since negative news is generally stronger than positive news, it works well through crisis periods where the volume of negative news is higher. To highlight the value of sentiment, we created thousands of long-short portfolios to generate 2 information ratio distributions as shown here on the slide. The yellow distribution, which is completely random, where we have picked 20 stocks long and 20 stocks short, created a strategy on a daily basis, and then looked at the distribution of information ratios of the thousands of portfolios we were creating. And also the red or orange distribution here, where we increase the probability of getting selected and be part of the portfolio based on in proportion with the positive and negative sentiment. So the more positive sentiment a company had, the more likely you were to be picked as a long position in your portfolio, and the more the negative sentiment a company had, the more likely you were to be picked for your short position. From this graphic, it's clear to see that sentiment adds value through all 3 crisis periods with information ratios well above 2.5. Even in the recent coronavirus crisis, we have seen information ratios well above 5. And what we can also see is that the extreme sentiment portfolios, where we select the top 40 stocks, so 20 long and 20 short each day, so it's basically a single pick, are falling into the extremes of the distribution, also showcasing the value of extreme sentiment as a stock picker on its own. The distributions driven by sentiment in general are clearly shifted more positive with greater average performance that fall well into the extremes of the purely random distributions as represented by the yellow line, showcasing the statistical significance of doing stock selection through crisis periods based on sentiment. This is not only true in the US large and mid cap universe, as we have shown here, but it's a result that is consistent across size as well as across region. Over the last few weeks, the RavenPack team has worked hard on coming out with our new public coronavirus news monitor, The dashboard is leveraging RavenPack's proprietary news analytics technology, which is predicated upon a corpus of over 19,000 sources of premium and publicly available news content. The dashboard is meant to help investors get valuable insights about the coronavirus, to get a better understanding of when we might expect the economy to recover due to improved sentiment or less references to panic or hysteria in the news. In creating the dashboard, the first thing that we are doing is screening for any new story that has mentions of coronavirus, COVID-19, or any derivative thereof. Starting from the left-hand panel, we can see the total number of global cases. And below that, there are various indices which have been calculated based on a few different thematic indicators. As we can see, we have a panic index, media hype, fake news, sentiment, as well as a few other indices below that. It's possible to expand each one of these boxes and add an overlay of one of the other indicators to see how they may be interacting with one another. Here I show the panic index against media hype. While they are both highly correlated, we have started to see the panic index improving more recently. Focusing instead on sentiment, we can also observe an improvement since its March 31st low, which supports the improved market conditions we have observed recently. Moving over to the center column, the geomap will show us up-to-date statistics of the outbreak for each country. We can also view each country's attendance sentiment, which scales from -100 to +100. We can also see the media exposure each country is receiving. Below that, in tabular form, we have a breakdown of how various entities are being exposed or impacted by coronavirus. We can toggle between industries to see which companies may also be receiving the most disproportionate amount of news exposure, or we can track politicians or potential vaccines in the news. At the top of the right-hand column, there's a news feed showing us up-to-date stories matching coronavirus. We can click on any one to be brought to the underlying web source of each story. Finally, below, the related topics widget is showing us any trending theme, topic, or event in relation to coronavirus, which is leveraging RavenPack's unique ontology and event indexation technology, allowing us to see the importance of each topic and its day-to-day change. While the default dashboard focuses on global insights, you can easily drill down to any country by clicking on the world map or using the country selector on the top left. Based on your selection, all of the indices and widgets will automatically update, and the news feed will filter on the relevant news. We are very excited about what we have developed. We believe you should bookmark it and use it as a daily resource to keep track of any changes in the market. We will keep developing the dashboard, releasing new exciting features. We have made it publicly available, and it's our small contribution to helping investors getting through the crisis.
Thank you very much, Peter. And now I'm going to hand over to Yin Luo for the second half of the webinar.
All right, thank you again for inviting me to discuss some of our research dealing with the global pandemic. This is what we call the global COVID-19 crisis, or GCC. In today's talk, I want to focus on three topics. Number one is a fairly simple epidemiology model, which we built for each one of the major countries and regions and states within the US. And number two, I think more importantly, we want to talk about how we can take advantage of alternative data provided by RavenPack, our partner. We're very grateful for RavenPack give us access to the data. And we want to talk about a suite of the sentiment and sensitivity indices we built using RavenPack data, which we find is actually quite interesting, leading the actual number of infected patients and also number of deaths. So we can use the RavenPack sentiment data as a financial signal to model the economic impact, but also the financial impact. Then last, I will talk about the impact in the financial market, and more importantly, how do we propose what we call the investment solution to a global health crisis. So first of all, let's start with some of the background reference materials. In this slide, you can see 8 papers we referenced. These 8 papers discuss everything from our epidemiology model we built, starting from late January for China, for Wuhan, where the disease started, where we can build our epidemiology models. We can track our out-of-sample performance of the model predictions. But later on, we built further extended the model to the rest of the world, Europe. That's when we started the second stage of the transmission, and then we got back into the United States. And we talk about economic impact, which I will not have time to discuss today. We'll talk about how we built our sentiment index using RavenPack data, and we can study the economic and the financial impact. Lastly, we'll finish off with the investment solution we propose for this global pandemic. So first of all, let's start from a fairly simple epidemiology model. This is a bit difficult, and one of the most difficult parameters to build such the infectious disease model is really a parameter we call R0. And essentially, the number of patients can be infected. This is a fairly difficult question. Again, based on the current academic research, we know the range of R0 is fairly wide, anywhere from 1.5 to probably 3.5. Some researchers are even proposing a much higher number. We know this coronavirus is very contagious, but we don't really know how contagious it really is. And the problem is many patients do not show any symptom. We still don't know exactly the percentage. That ratio can be anywhere from 20% to over 50%, and this really stop us from a model full or the real number of infected patients. But nonetheless, let's starting from a simple simulation. This is a model we built in the middle of January. It was mostly designed to model the number of patients in Wuhan city and to some degree also to Hubei province in China. And then later on, we can compare this simple model with the rest of the world, with the rest of China, but also with other countries. In the simple simulation, the projection was basically by the peak of the season, which is by middle of February, the model estimating the number of patients depends on the level of the social distancing, depends on the effectiveness of the containment conducted by the Chinese government. We're estimating the number of infected patients can be somewhere between 50,000 or even more. And of course, as we know, the final number reported by the official media is somewhere around 67,000 patients. So I think the out-of-sample predictions was reasonably accurate. But then we have to discuss about the effectiveness of the social distancing. And this is, of course, what we call the flattening the curve. And so we think the level of the social distancing is quite different. Some countries implement almost like let it go. We'll probably have a fairly limited number of social distancing, and hopefully we can build a herd immunity. And some of the other countries, of course, as you can see from South Korea and China, have almost implemented a full lockdown of the entire country. So, and most other countries probably somewhere in the middle. You can see on this slide is the effectiveness of the social distancing can be quite different. Let's take 2 extreme examples. One is in the Hubei province, where it started. Right? So, of course, the local government did not have enough experience dealing with the infectious disease. We know it took a very long time from this zero, where we have enough number of patients, to where we're starting to see the peak of the line. It took about 31 to 32 days, very long, versus the rest of China, Hubei, which is very different experience. We can see the peak really started around 20 days, almost like 2 weeks before when it really peaked in Hubei province. We know kind of what happened to, of course, what happened to Italy, for example, where there is an aging population. We know the number of patients, the number of deaths can be even more severe, versus another example, which is New York. It started a little slow, but eventually it picked up both the number of testings and also the number of the effectiveness of the social distancing. We see starting to decelerate, although we haven't really seen a peak yet. Again, this is the model we built towards the middle of March, and the projection was by the end of March. We estimate the number of patients in New York State is probably going to close to 100,000, versus the total number of patients in the U.S. will probably close to around 200,000. based on the more of strict rules of social distancing. Again, with hindsight, both estimations seem to be reasonably accurate. And the problem with the conventional epidemiology model is, as I mentioned earlier, it depends on many parameters that we're not so sure, but also depends on the level of social distancing. Again, this is also very difficult to model. And this is really pointing to the second part of my presentation, is how can we take advantage of alternate data, and in particular, it's almost like a crowdsourcing of the wisdom of the crowd, because of different researchers around the world, different government agencies doing their own work. And this is being reflected in the massive coverage in the media and social media around the COVID-19 crisis. So we can take advantage of this crowdsourcing by building a sentiment index. We also have a companion index called uncertainty. Uncertainty really measures the number of measures, and the sentiment measures directions. And this is quite important, where we rely on the RavenPack sentiment engines to quantify whether a given news related to COVID-19, whether it's positive or negative. This slide shows you the number of different steps, and we build our index. Obviously, the most important one is this is specifically related to COVID-19. This is also specifically related to either a given country, a region of the world. We also further later the news events to be as health related, and we're excluding the opinion pieces, so we're only covering the more fact related. And this is essentially a data index we built for every single major country and region in the world. As a simple motivation you can see on this slide, we related to the number of the new infections alongside with the COVID-19 index for China. As you can see, it is for China, the sentiment really bottom towards the end of January. That's when they're starting to really bottom, versus the number of infected cases peaked around 2 weeks later. And if you're actually running a statistical testing, you can actually see, very interestingly, the sentiment index actually strongly leads the number of new infections. So we're starting to see the sentiment peak around 2 weeks before the number of patients. We're also starting to see the sentiment starting to moderate, really starting again a few weeks before the number of cases starting to decline in China. We see the same evidence in the US. In this case, we plot both charts. Number one is the number of infections in the bottom left. Number two is the number of deaths in the bottom right. You can see both giving us fairly interesting pictures. Statistically speaking, we also see the sentiment in both cases leading the number of infections, leading the number of fatalities, which is quite interesting. We're starting to see the sentiment in the US as of this stage really bottom, really in the end of February. That's when it's starting to take off in the US. That's when we're starting to see a community transmissions. The reason of a dip in sentiment coincides with the White House predictions of a number of fatalities, which is really trigger another round of panic in the financial market. Based on the sentiment index, we can actually conduct a number of analyses for both the economy, and given the time, I'll try to focus on more on the financial market. The first analysis is a simple event study. Right? So given we have a fairly short history of the sentiment index, really for China starting from middle or early of January, for the US really started from late January, early February, so we have a fairly short period of time. So we thought an event study is probably more relevant. Using event study, we can see what is really the impact on the various industries, meaning what are the most defensive ones, and then what are the industries are more exposed. Right, so we do see some similarities in both US, what is happening in the past couple of days or weeks, and also China, where the disease is already well contained. But in both countries, you can see obviously the food, the healthcare industries are more defensive. When we are confining our homes, right? So what else can you do, right? So other than buying groceries and buying food, what is really our hope really about developing either hospitals and treatments, or even better, probably a vaccine. So we're definitely seeing the healthcare industry along with the food and staples, all the classic defensive industries. On the other hand, the most exposed industries are energy. So we have a double whammy. Not only we have a demand shock about energy, but also we have a supply shock. Right? So we know there is a price war between Saudi Arabia and Russia. So we're seeing energy being the most exposed. along with some of the other classic cyclical industries, such as transportation and capital goods. Again, those are subject to gross demand and supply shocks. We can also study whether the factors or styles are being more defensive and the ones are more exposed. Right? So again, classic example is the low beta, the low risk, high qualities are being more defensive in both US and China, and the ones are more affected and maybe more cyclicals, both the markets, so classic cyclical signals, so the cyclical values are being most negatively exposed. Well, now let's shift gears away a little bit away to something we observe as quite interesting, but also quite shocking to active asset management communities in the equity world in particular. And this is something we call almost like an unprecedented level of deleveraging we observed among the 3 days, starting from March 13th and finished around March 17th. So obviously this was triggered by the GCC or global coronavirus crisis. They amplified by the subsequent economic impact. The financial market really felt the pain, and the hedge fund community initially was probably triggered by some of these targeting fund disparities as they're reducing leverage, we're starting to risk starting to amplify into the other active management space. The hedge fund community was being forced to deleverage to cover risk, and we're seeing this unprecedented level of deleveraging happen among 3 days. We're using 3 factors of proxy this hedge fund deleveraging. The first one is called crowding, where it measures the long side ownership data we collected. So this is a collected long shares owned by the hedge fund community as a proxy for the long side. The second one is using short interest. So fairly complementary because the crowding measures is based on mostly the 30-X data, which has about 45 days of delay. We're tracking for most of the longer horizon hedge funds, so that's not a big problem, but still the data is not exactly up to date. On the shorting side, we're using a real-time securities lending data offered by market. And this is really daily T+1, so we have a real-time measures on the short side. And the third one is a quantum positioning signal. Again, this is proxied by one of our flagship global stock selection models. I want to highlight particularly the hedge fund crowding. This is where you can see at the bottom right-hand side chart, we really observed almost like 3 massive events in a row. On March 13th, we saw almost like a negative 5 standard deviation event, followed by the next day exceeding a 7 standard deviation. But the most pain we saw was on March 17th. There was almost like a 16 standard deviation event. So what is the chance of observing 3 such a massive size of events in a row? Based on the normal standard deviation or normal distribution, we only see this probably 1 in billions of years, right? So we are unlikely to see this, I think, the assumption of the Earth. Of course, in financial market, we know financial data subject to very long lag tails and with access kurtosis, but still this is something even exceeding the level we observed in the 2008 global financial crisis. Not only in the hedge fund space, but also we're seeing many other factors. We're also seeing very sizable moves. In particular, we're seeing liquidity, right? So the highly liquid stocks were being sold first to meet the margin calls. So high liquidity stocks really underperform, which is very uncommon compared to size, right? So normally speaking, liquidity and size will be in the same directions. Now with highly liquid stocks underperform, we're also seeing large cap stocks outperform. So this is highly unusual. In both cases, we've seen the level either match or even exceeded the level we observed in the global financial crisis. What is really the new novel risk, right? So we're seeing this hedge fund deleveraging, which is already normalized in the past couple of days or weeks. The next real risk, what we're seeing is really in the credit space. So for equity investors, we're seeing the biggest risk in the next couple of weeks or a month is probably credit, what kind of normal equity risk factors. This slide shows you in a kind of a normal environment, macro or style factors along with factors count for probably around 20% of the overall equity risk. This is for U.S. equities. But in the past couple of days, what we've seen is macro starting to account for almost half, or sometimes even more than half of the total risk, meaning It's not really about stock selection anymore. It's really about the macro in particular. We're seeing high strong crowding, but also even more so we're seeing this credit risk starting to emerge, have a higher and higher explanatory power alongside with expansion of high yield spread and also credit spread. So this is definitely one of the key risks we need to watch for. This is one of the other tools we want to introduce is to help our clients to track factor stretching or distortions, how long it's going to last, and also what's likely the downside severities. We built a toolbox, which is an online tool you can track for factor performance, for whether factor performance being distorted, the severities and durations, and you can use this to analyze hundreds of factors for global equities. Now let's say shifting gears towards the last section of my presentation, which is an investment solution for a health crisis. And this is one of our best performing models, not only just year to date, where the model has performed extremely well, but also in the longer term, so we find this is one of our best performing strategies. To give you a little background, the name suggests, right, so just as the name suggests, a shield is a model we designed to perform well when the market goes down, right? So it's really designed as a downside protection. But unlike most of the other, let's say, downside protection model defensive strategies or tail risk hedging strategies, this model also works well even when we have a major market round. So we don't expect the model to perform extremely well in a big up market, but we do expect the model not to suffer too much in the major market rallies. But in a sense, it's giving you this interesting asymmetric payoff patterns. It works well when the market goes down. The more the market goes down, the better the model performs. At the same time, should not give up the upside participation. On this slide, you can see the month-to-date or year-to-date performance. As we know, in the first quarter of this year, the equity market was down significantly, one of the worst quarters in history. The maximum drawdown of S&P 500 and also MSCI World was over 30%. And you can see the shield model is up by more than 11%, almost form a perfect mirror image of the equity market. But what all you can also see is even when the market was up more than 1%, there are not that many days, the shield actually still delivered very interesting positive daily returns of 19 basis points. We also see this the same thing going back longer term in the history. We can see, right? So anytime when we have a major bear market defined as MSCI down by more than 3% in a month, the Sharpe ratio of the shield was extremely strong, over 4. When the market is range bound, you can see the model also performed reasonably well with a Sharpe ratio close to 2. Even when we're seeing a major market rally, the shield model was essentially flat, which is quite different from a conventional defensive strategy, meaning we actually earn a positive premium in the longer term, but also give us that much needed downside protections. So how the model is being designed, this is really leveraging a number of different things. Number one is leveraging our risk controls, right? So we basically neutralizing all of our input factors and features or variables against all of these major risk factors that tend to suffer at the major market turning points, such as country, size, beta, but even more so about price momentum. Number two, this is leveraging our strengths in alternative data, factor designs, machine learning techniques. So the shield is really designed as a full-blown machine learning algorithm. We're using machine learning algorithm to help us identify the factors, identifying the patterns. And in the end, we try to emphasize the shield focuses really on the idiosyncratic nonlinear patterns that's specifically presented in the bear market environment. And at the same time, these patterns tend to be probably more like a random noise in the major market rallies, meaning we probably won't able to capture much of alpha in the big market rally, but hopefully we won't lose money in the market upturns. So hopefully the model design is give you the downside protections without giving up upside. This is a simple comparison of the shield with some of the other common defensive strategies, such as high quality, such as credit default models, low beta, low volatilities. But if you look at the bottom left-hand side chart, you can see this. The red bar measures alpha in the bear market environment. As a shield, delivers similar alphas in the bear market environment as other defensive strategies. But the most interesting part is when we're seeing a major bull market, such as either the market goes up, or if you look at the chart on the right, when the market rallies by more than 5%, the shield deliver either slightly positive or slightly negative performance, but most of the other defensive strategies tend to suffer as they get, again, it's just the more the market rallies, the more of these typical defensive strategies are really suffer. Okay, so we want to focus on stock selections. We don't want to do unintentional market timing. But the problem with the typical defensive strategies is they actually end up with being betting on unintentional market timing, meaning they perform well in bear market, they struggles in the major bull market, versus our shield model, you can see this very interesting asymmetric payout patterns. Not only at the major market turning points, if you look at the performance in the longer term, the shield is built on these red bars versus the other color bars representing the other typical defensive strategies. This is over a fairly long horizon, over 20 years for each one of the 9 regions of the world. That's the US, Canada, Latin, in Americas, Europe, UK, and the emerging EMEA in the European regions, Asia, Japan, Australia, New Zealand, in Asian Pacific. You can see in the longer term, the shield delivers Sharpe ratio, which is probably around 10 times higher than your traditional defensive strategies. But even more so, the shield achieve that performance with a much lower drawdown. So downside risk is probably around 10–20% of your traditional defensive strategies. It works extremely well, obviously, in the major bear market, but also when you look at when we're facing a major market rallies, such as what we saw in the March 2009 environment, the past couple of days towards the end of March, the shield model actually holding up fairly well without suffering at the major market turning points. Lastly, what I want to show you is how you can potentially using the shield in a classic, let's say, either as the owners or as the managers environment. This is pretty simple simulations for a typical 60-40 equity bond allocation, probably more of a conventional pension fund, sovereign wealth fund scenarios. And we assuming you can replace your equity components with the shield model. This is our global long-only shield, right? So we have 4 investable products. We have a global long-only version. We have a global long-short. We have a US long-only. We have a US long-short version. Depends on if you more like the alpha or alpha plus of the beta components. In this case, we try to replace equity allocation. So we're going to use our long-only product as a simple example. The upper left-hand side chart shows you we're replacing the equity components with our shield at the 50% weight. You can see definitely the shield model replacing that passive benchmark. We can massively improve our performance. The cumulative returns annualized, we boost the returns from around a little bit above below 7% to just about slightly below 9%. So you get almost 2% actual returns per annum. At the same time, the maximum drawdown is actually coming down from around 33% to somewhere below 28%. So your downside risk down by 5% per annum, and your actual returns goes up by 2%. Your Sharpe ratio goes up by more than 30%. The other simulations are done in a similar way, meaning you can also use a long-short version of the shield as a cash replacement. Because the good is fairly earns a higher average premium than the shorter term, let's say treasury of the securities, definitely much higher returns than cash type of securities. At the same time, also give you the negative correlations with the market. You can replace it for more of a balanced fund for the cash components. For typical active managers, either fundamental managers in the bottom right, or a typical quantitative managers, risk premium affecting investing funds, we can see replacing some of the equity components or cash component with the shield, we're seeing some meaningful improvement in performance. Lastly, what I will show you is this is only one example about our global long-only shield strategy. This is a live strategy we've been tracking for a couple of years. On this slide, you can see some of the live performance. Basically, what it does is right, this is a long-only strategy that's tracking the market, but does give you some of that alpha components. And we also have a long-short version of the strategy. This is mostly emphasizing on the absolute returns of that components.
Thank you very much for that, Yin. And now we're going to open it up to our live Q&A.
I can see the first question coming in here. It is for myself. In your presentation, you showed examples of how you could do stock selection within sectors for names that had exposure to coronavirus. You showed the example of biotech. Is that possible within the dashboard that you also showed? Yes, it's possible to do stock selection in part of the dashboard. There was a section specifically below the geo map where you could look at what companies had exposure to China exposure, coronavirus exposure, and you could see, for instance, picking the top 5 companies that had most exposure to the coronavirus, which within each sector, and sort of do that selection from that point of view. There's another question that talks about the content of news that is feeding into the analysis and on the dashboard as well. There's talks about, or the question goes whether what happens to articles related to China, if it's English language news only, or if it's local content. Right now, the dashboard operates only on English language news, and that's also the RavenPack offering in general is focusing on English language news. However, we are, as an organization, working on expanding into a multi-language offering, and it's something that is coming at a later stage. There's also another question here for Yin, and that is, I mean, it's been interesting to look at how you were able to sort of predict the pickup on or how many cases, new cases you saw based on, for instance, news leading it. Have you tried to update your models to see how it has worked more recently, or whether it was only something that was predictive in the beginning when it first you saw the early stages of the outbreak?
Yeah, no, thank you, Peter, for the question. So first of all, before I dive into the answer to the question, I just want to mention so first of all, we use a couple of different sources to track the impact of COVID-19. One, as I mentioned in the presentation, is using RavenPack data. We build our global COVID-19 sentiment indices for each one of the major countries. This is mostly based on English language. The second one is actually mostly tracking at the individual company level, where we're using a couple of other sources. One is about companies' regulatory filings, so annual reports, interim statements, and so on. And this is actually based on multilingual, so we're tracking 21 languages. So in the sense is we do track for the impact for Chinese companies in Chinese language, for Japanese companies in Japanese, and German companies in German. Of course, we're also tracking for English language. Many of these companies and mentionings and findings can also be done in English language. So we do track those at the local level. Then getting back to the question, which is, do we update our epidemiology models and what the model is telling us? I think the billion-dollar question, of course, is when are we going to see the turning point? So the answers to those are, yes. So we do also have the automatic updates. So anyone interested, please feel free to contact myself or contact Peter at RavenPack, and he will direct questions to me. Is we do update our epidemiology models, and we do tracking for and predicting for the number of new infections, the number of deaths, and hopefully the turning points. And roughly speaking, is we do see, again, I agree with President Trump, we do see the end of the light at the end of the tunnel. We do see the speed of the increases has slowed down in U.S., particularly in New York State, and also in most European countries. So based on the evidence and the models, and we fit it using China's data, I think we're probably about another week or 2 weeks away from actual peak. And then starting from then, hopefully we're starting to see the number of infections will eventually come down. But this is not necessarily a signal to extreme optimism. Whereas the problem, as we're seeing in Asia, is Asia starting to face the second and third round of new infections. Right, so again, this is a near-term outlook is probably still fairly bleak until we can find effective treatment, vaccine, or at the very minimum, a very effective way to testing patients and testing and tracking for infections. It's still very difficult to open up the economy. Once we open up, we likely to see another round of infections, and we'll have to impose lockdowns and social distancing. So there's a kind of a circular effect where we like to see multiple rounds of on and off. And this is where, again, the news sentiment comes in. As I mentioned in the presentation, we do find the news sentiment as a proxy for crowdsourcing, actually leading into the actual stages of the different outbreak. So if you're using the news sentiment, you can also see it's used for China, for Japan, for Korea, for many of the Asian countries. We're starting to see a sign of the sentiment starting to deteriorate a little bit again. This is again mostly accounting for the potential of a second round of an outbreak. We're starting to see the sentiment starting to improve in Europe and in the US. Is mostly indicating likely we're going to see the outbreak starting to getting better controlled or at least mitigated in the US and Europe. So we do see again the epidemiology model and the sentiment actually go hands in hand. They do give us a double confirmation.
We have a couple of other questions here. There's a question with regards to media exposure to China. So that must be with the examples with airlines. How do you determine the exposure? Is that just the raw article counts to articles related to China? Yeah, I mean, it's a fairly simple analytic that we're looking at here. We are looking for China as an entity detected by RavenPack within an article. It is a named entity recognition system that is in play. And what we have been looking at is just what we consider conmention analytics or conmention volume, where we say the two different entities has to have been mentioned in the same article. So it's a proxy for their exposure or their relatedness. So we have been looking at the percentage of all stories for a given company over the last 2 years that mention China compared to the total volume for that name. So the higher the percentage, the more exposure that company was, or airline company was sort of considered having. So it should be considered a proxy, and of course there would be other ways of measuring China exposure that could also be interesting to use in combination with this. There's another question here as well, asking about or referencing academic research that has found that ETFs that contain the most positive sentiment stocks underperformed in March 2020. How do you reconcile that with your long-short strategies? It's a good question. I assume that that's related to the random portfolio distributions that I was showing through the crisis period. And one thing to highlight here is that the strategies that were presented there are short-term strategies. So it was based on a daily rebalancing. And it may well be, I haven't necessarily read the underlying research that is referenced here, but I can assume that it might be not with a daily rebalance necessarily. And therefore, what you might be seeing if you're focusing on slower moving signals, that you're seeing that there might have been some reversals. So initially, you could have seen an initial momentum effect or trend following effect as the news hits, and then you see the reversal kicking in later. We have also observed when we evaluate beyond the downside period, which is really what we are focused on in the distribution, that you have gone through a recovery period where the reaction to sentiment was in inverse. So it's almost like the ones that have had the most negative sentiment and have been beaten up in the market, they overreacted to it. And as you were seeing, may have continued seeing a negative sentiment, you actually started getting more of a positive reaction because there were more macro-based information that was driving, like the stimulus packages and so on, that was driving the upside rather than the individual company news. I think, unfortunately, at this stage, we are out of time. So unfortunately, we can't take any more questions. We will obviously look at all the questions that have come in, and we will try and reach out via email to answer the questions that you have posted. Also, I would like to highlight that we will provide the video and slides to everyone after the webinar. If there's anything you missed, or if you would like to share the content with some of your colleagues. So basically, I'd like to thank you for joining, and please stay safe. Thank you.
This is RavenPack.